The biggest risk to stocks in 2024. Investors are feeling bullish after the Federal Reserve flashed a major dovish signal to market this week, but stocks still face a cocktail of risks headed into the new year, Wall Street forecasters say. Bearish predictions have become the counter-narrative of late as investors and analysts dial up their expectations for stocks to hit all-time highs next year. Those expectations are grounded in the outlook for the Fed to start cutting interest rates as early as the first quarter. In the central bank's summary of economy projections at its meeting on Wednesday, officials hinted at 75 basis points of rate cut next year, a move that vaulted the Dow to a fresh all-time high this week. But the bullish mood shouldn't gloss over risks that are still facing the market, and experts say there are still big headwinds to another major rally next year. Here are some of what Wall Street sees as big risks to stocks in 2024. Number one, recession strikes. Though the Fed is expected to dial back interest rates soon, the economy still risks tipping into recession thanks to the accumulated financial tightening that's already taking place in the economy. Even a hint of a recession could send stocks plunging, French bank Société Générale warned, and there are parallels between today's market and conditions since in 1987. That was the year the market was roiled on Black Monday, when the Dow plunged 22% in a single trading session. The equity market's current resilience in the face of risk and rising bond yields reminds me very much of events in 1987 when equity investors' bullishness was eventually squashed, strategists at the financial service firm said in a recent note. They added that stocks could see a devastating blow if a recession were to strike. That bearish view is shared by strategists from BCA Research who warned stocks could plummet as much as 27% when the economy tips into recession. A plunge that steep could mark the worst stock market crash since the 2008 financial crisis. A recession in the US and Euro area was delayed this year but not avoided. Developed markets remain on a recessionary path unless monetary policy eases very significantly. As such, the risk to reward balance is quite unfavorable for stocks, BCA said. Number two, the debt bubble burst. Now, Universal Investment, a hedge fund that counts the Black Swan author Nassim Taleb as an advisor, recently predicted stocks would experience a crash even steeper than 1929. That's due to a huge debt bubble forming in market when interest rates were ultra low, which is set to pop as borrowing costs remain higher for longer. We are in the greatest credit bubble of human history, Universal's chief investment officer Mark Spitznagel said in an interview with the Intelligencer. It's entirely because of artificially low interest rates, artificial liquidity in the economy that has really happened in a big way since the great financial crisis. Markets saw a wave of corporate debt default so far this year as rates rose and refinancing became more expensive for companies. A worsening pace of debt failures could spell trouble for stocks, and a tougher credit environment combined with a full-blown recession could result in nearly $1 trillion of corporate debt defaults, Bank of America previously estimated. Number three, the highly valued S&P 500 sees a big recession. Now, part of the S&P 500 are looking overvalued. Ultra-low rate throughout the pandemic drove a stock market frenzy that's accumulated this year with a wild run-up in a select handful of stocks, dubbed the Magnificent Seven. Now, these tech firms have seen massive investment this year, eclipsing the gains in the rest of the benchmark index. As the era of extreme liquidity comes to an end, rates are likely to stay higher for longer, even with the outlook for rates cut next year. That could be bad news for some of the market's most hyped stocks. Legendary investor Jeremy Grantham told Business Insider he expected the S&P 500 to plunge as much as 52% in the worst-case scenario thanks to a super bubble that's bound to burst. A drop that steep could send the S&P 500 plunging 2,200, an even steeper drop than when stocks initially crashed in the early days of the pandemic. Stocks are looking so overpriced that the market could crash as much as 60%, veteran investor John Hausman recently warned. He compared the current stock environment to years like 1929 and 2000, right before the Great Depression and the bursting of the dot-com bubble. That's not the forecast, but it's certainly a historically consistent estimate of the potential downside risk created by more than a decade of Fed-induced yield-seeking speculation, he said in a research note. Buckle up. Fears of a stock market crash have been rising steadily even as the bullish chorus grows in the latter part of this year. According to Yale's U.S. Crash Confidence Index, 61% of institutional investors think the odds of a 1987-style stocks market crash is higher than 10%. Number four, a black swan event. Now, while black swan events are by their nature unforeseen and therefore difficult to predict, there are a few outlier scenarios that investors are eyeing that could spoil the party in markets. The risk of black swan event on par with something like the COVID-19 pandemic stem mostly from the high level of geopolitical risk in the world as 2023 winds down. Top economist and market doomsayer Nouriel Roubini, in a recent op-ed, pointed to escalating tensions between the US and China as one of such events that could trigger a calamity. Aggression between the two superpowers could eventually heat up into a full-blown war, which could be catastrophic for the world economy, Roubini warned. If they fail to achieve a new understanding on issues driving their current confrontations, they will eventually collide. That would lead inexorably to military confrontation that would destroy the world economy and which could even escalate to an unconventional conflict, according to the Dr. Doom economist who is known for his bombastic prognostications on Wall Street. Conflict between Israel and Hamas, meanwhile, could also spill out into the wider Middle East region, Roubini said in a recent Bloomberg interview. Spreading conflict could cause oil prices to spike, potentially sparking a stagflationary crisis in the West. Roubini recently warned that a stagflationary crisis could cause investors to lose trillions of dollars over the next decades. It's not the baseline scenario, but it's a risk, Roubini said shortly after the latest conflict between Israel and Hamas began in October. The market seems to be discounting the possibility of a massive conflict for now, he added.